The Bank of England, often referred to as the BOE, sets monetary policy for the UK, just as the Federal Reserve does for the United States. When it raises or lowers rates, it directly affects British mortgages, corporate borrowing costs, consumer spending, and business investment. But indirectly, those moves influence global investors, multinational corporations, bond markets, and currency traders worldwide. That's because the UK is still one of the largest financial centers on the planet, and London remains deeply embedded in global banking and capital markets. Right now, the biggest question isn't simply whether the Bank of England will cut rates, it's when, and how aggressively. Inflation in the UK has been stubborn, particularly in services and wage growth. If the Bank of England signals that inflation is still sticky and rates must stay higher for longer, that could send a message to global markets that the fight against inflation isn't over. And if inflation pressures remain elevated in the UK, investors may start wondering whether the Federal Reserve will also need to delay its own rate cuts. On the other hand, if the Bank of England pivots earlier than expected and begins cutting rates aggressively, it could create a different kind of ripple effect. Lower UK rates would likely weaken the British pound relative to the US dollar, especially if the Fed maintains higher rates. A stronger dollar might sound positive at first glance, but it carries consequences. It can pressure multinational US companies that generate revenue overseas, because foreign earnings translate into fewer dollars. That directly affects earnings reports for major S&P 500 corporations. Currency markets are often the first place these shifts show up. The British pound is one of the world's most traded currencies. When expectations around UK interest rates change, Forex traders react instantly. If investors believe the Bank of England will cut faster than the Fed, capital may flow into dollar-denominated assets seeking higher yields. That increases demand for US Treasuries, strengthens the dollar, and tightens global financial conditions. In contrast, if the Fed cuts first and the UK holds steady, the dollar could weaken, providing support to commodities and emerging markets. Bond markets are another critical piece of the puzzle. UK government bonds, known as gilts, compete directly with US Treasuries for global investor capital. Pension funds, hedge funds, and sovereign wealth funds constantly compare yields across developed markets. If gilt yields rise relative to Treasury yields, capital could rotate into UK bonds. That shift can push US yields higher, which affects mortgage rates, corporate borrowing costs, and stock valuations in America. It's a reminder that bond markets operate globally, not nationally. There is also a psychological element that investors often underestimate. Central banks influence markets not just through actions, but through forward guidance. A single sentence in a Bank of England statement about inflation risks can change global expectations. If policymakers signal concern about persistent wage growth or tight labor markets, investors may interpret that as evidence that inflation worldwide could remain sticky. That shapes expectations for central banks everywhere, including the Federal Reserve. Financial stability risks must also be considered. The UK housing market is highly sensitive to interest rates because many mortgages reset more frequently than in the United States. If high rates begin to stress homeowners or corporate borrowers, it could create economic drag. And because global banks have cross-border exposure, stress in one major economy can quickly influence credit conditions elsewhere. While this is not the base case, markets always price risk ahead of time. Global equities are directly connected to these signals. If UK policy suggests economic slowdown in Europe, that could weigh on broader European markets. US companies with strong European sales exposure might see reduced demand. But if the Bank of England successfully manages a soft landing, reducing inflation without causing a recession, it could boost investor confidence in developed markets overall. That optimism often spills over into US equities. Emerging markets add another layer. High interest rates in developed economies tend to pull capital away from emerging nations because investors prefer safer yields. If the UK begins easing and global liquidity expectations improve, emerging markets might see renewed inflows. However, if both the Bank of England and the Federal Reserve keep rates elevated longer than expected, global liquidity could remain tight, creating headwinds for risk assets worldwide. Commodities also respond to these signals. A stronger dollar typically pressures gold, oil, and industrial metals because commodities are priced in dollars globally. If UK rate decisions contribute to dollar strength, commodity markets could feel that pressure. Conversely, a weaker dollar environment often supports commodity prices and energy stocks. So what should American investors watch closely? First, pay attention to Bank of England meeting statements and voting splits among policymakers. A divided vote can signal policy uncertainty. Second, monitor UK inflation data, particularly wage growth and services inflation, which tend to be sticky. Third, watch the spread between UK gilt yields and US Treasury yields. That spread often drives currency movement and capital flows. The most important thing to remember is that markets move on expectations before actions. By the time the Bank of England officially cuts rates, markets may have already priced it in months earlier. Futures markets and bond yields adjust based on probability, not confirmation. That means the real market moves often happen in anticipation. This year could mark a turning point in global monetary policy. If the Bank of England leads the next easing cycle, it may signal that inflation is finally under control across developed economies. But if it delays cuts due to persistent inflation, it could indicate that global tightening will last longer than investors hope. Either outcome will influence the US dollar, treasury yields, equity valuations, commodities, and global risk sentiment. In today's financial system, no major economy operates in isolation. A policy decision in London can influence portfolios in Los Angeles. A rate signal from the UK can impact 401k balances in Florida. Capital flows move across borders instantly, and investors who pay attention to global signals often stay one step ahead. So while most headlines focus on Washington and the Federal Reserve, smart investors this year will also keep a close eye on the Bank of England. Because sometimes the shifts that change global markets don't begin on Wall Street, they begin quietly overseas. And when those signals start flashing, the ripple effects can reach every corner of the financial world.